was trying to come up with what I'm going to speak with you today, and I've spent the past week, I know you all enjoyed Father's Day, I spent the whole time since the 15th calling up people to remind them to make their estimated tax payments. So, for all of you who wonder why you make estimated tax payments, it's real easy. Everything you do, all your taxes are prepaid. And that's the problem. For most of us, you get a W-2, your taxes are taken out of it. At the end of the year, you file a return, you get them back. It's real simple. But for most of the people here in the room, you're business owners. So when you think about somebody who owns a business, or somebody who's dealing with stocks, or if you got rental properties, your income doesn't have any withholding. And that's when you have to make estimated tax payments. In general, when you're making estimated tax payments, there's two reasons to make one. And I'm going through this real fast, so slow me down if you need me to. First reason is, of course, if you have a sudden large windfall. You sold a house, sold some stocks, you got lucky at the races, whatever happened, you're going to need to make an estimate, not so much to avoid the penalties, but because you don't want to be writing a huge check come April. While you have the money in your hand, pay it to the government now before you spend it all. But for the rest of us, it's more likely because we have income that is not withheld on. Retirement funds, business owners, whatever. And what you're looking for is underpayment penalties. When you want to avoid these underpayment penalties, they can get very expensive, but the IRS has established 3 different safe harbors, is what they're called. First one is, as long as you've paid in at least all of your taxes for the current year within $1,000. So at the end of 2014, if you owe less than $1,000 federal, it's $500 for California, then you're penalty proof. You don't pay any penalties. Well, I say penalty proof. There is timing issues, but in general, you don't have a penalty. The second one is, for those of you who do have some withholding, you have to have 90% of your current year taxes paid in withholding. So, S-Corp owners, if you're paying yourself payroll, give yourself a little bit of withholding, that'll help you clear that penalty. The problem with either one of those is you have to continually look at your current year numbers. That's tax planning issues, and that can get expensive if you're paying someone like me to do this for you. So what most people do, and what most tax preparers will do, is we will be looking at last year's return. As long as you pay in 100% of your tax liability for 2013, then you don't have penalties in 14. So if you've ever wondered why when you prepare a tax, or when you get your tax return back from your preparer and it has that estimate schedule, that's where those numbers come. They are looking as if your 2014 is exactly the same as 13, how much you would be short, and they've calculated what it'll take for you to pay in that amount, so you don't have any penalties. Of course, it means you have to keep some information. You have to give it to your tax preparer. Any life changes, you have children, you get married, somebody dies, you buy a house. You need to make sure that you're communicating this to your tax preparer, because if you don't, we're going to have you paying in the wrong amounts. If you converted to an S-Corp this year, your taxes are probably going to be a whole lot lower on your personal side than normal. So we need to know that. Otherwise, we're going to have you paying in huge estimates, and at the end of the year, you're going to have a huge refund. Sounds great, but it means the government's played with your money for months. You don't want to give them loans. So throughout the year, make sure you are talking to your tax preparer. Make sure that when you go to get your taxes done, before you finalize your taxes, sign it, and they give you your estimates, that you've told them anything that's changing this year so they can change your estimates, just so we can plan ahead. Last little piece of it we started talking about earlier when I was talking about the penalties is when you have to pay and the timing. For the IRS, it's pretty easy. IRS has front-loaded it slightly, April 15th, June 15th, September 15th, and January 15th. They're not 4 months apart or 3 months apart. 2 of the payments, because the government ends on June 30th is their year end, so they've moved the July payment into June so they get their money in the prior year. And then since now they've moved that back and they're broke, they've moved your October payment into September. It's actually been like this for years. It's not something they've just moved, but in general, they've moved it to focus it around the fiscal year for them. The other issue is the government does it in 25% increments. Right here, the little red bars. So the government wants you to pay 25% each quarter. If you have withholding, they consider it all being paid in first quarter. That's why somebody who does primarily withholding through payroll checks doesn't end up with penalties. California, on the other hand, wants it front-loaded also. They want 30% in first quarter, 40% in second quarter, nothing in third quarter, and then another 30% in fourth quarter. I said that backwards. First, second, third, fourth. So they've got it slightly scattered. That's why next, in 2 months when I start calling everybody to make their September payments, there is no payment for California, unless you missed your first ones. California also has a slight difference in your withholding. They do not consider your withholding all paid in first quarter. They consider your withholding number paid 25% each quarter. Unless you file a schedule telling them that your withholding was different throughout the year, that means that if you do the normal thing business owners do, giving yourself a huge bonus at the end of the year, you may still have penalties due from California for underpayment, because they will consider your first and second quarter payments late. So, a lot of information. I don't know if anybody caught most of that.
Yeah.
No.
Any questions on estimated tax payments?
I do.
Yes.
So if you have an S corp and you pay yourself some payroll, during the year, and take the rest as distributions, should you take that payroll earlier in the year or later in the year, or does it matter? Because it sounds like if on the California schedule, especially if you don't take it earlier in the year, then they might come after you. Is that?
For cash flow purposes, it's actually easiest to go ahead and set yourself up with a monthly or quarterly salary. But as far as taxes are concerned, it would be better if you wait till the end of the year for federal, because then you're not giving them your tax money until the end of the year. For California, obviously, you would have an underpayment penalty then. So to offset that, what you usually do is pay an estimated payment in the first quarter. That'll take care of your liability, keep you out of the penalties. And the other idea is, we want to eliminate your taxes as much as reasonable. Our firm does not try and make you have zero taxes, because while that's great for your taxes, that's usually not good for things like a car loan. They want you to have some income.
Or mortgage.
Or mortgages, yes. So we'll try and discuss with you what type of income level you need to show for your normal lifestyle, what you need to be doing. And then items like that, if you have extra money at the end of the year, instead of bonusing out to yourself and having it sit in a bank account, hook you up with a pension, get you in touch with Ron Budd over there, Ron Budd Associates, put some retirement away, plan for your future too. Because it's not just about doing your current tax return. If that's what we were doing, we'd be tax preparers. We are a CPA firm. We're here to help you plan your life and where you're moving. So we're trying to map you out all the way to retirement. So, any other questions? Yes.
One of the things about having an S corp is that you pay less in your Social Security tax. So what happens though is people will realize you minimize, maybe you're making $25,000 a year because you have all these expenses and you have this bonus, you use dividend. But the problem is then you go to try to take your Social Security at the end and you don't have much because you didn't pay in much. So there's a balance there. You've got to have some income, otherwise you'll have no Social Security. So that's part of his planning and Ron's planning. And we're going to do that Social Security seminar. So you may want to consider that before you get yourself in a corner and realize, oh, now I only get $1,000 a month, where I could have $2,500 a month and maybe Social Security.
Yeah.
So it's really important, it's planning.
Yeah, S corporations are great that you can bifurcate your income. Part of it comes to you as earnings on an investment, so it's not subject to self-employment taxes or payroll taxes. And part of it comes for you for your duties you perform for the company, and that is payroll taxes. But like Crystal was saying, it means there's no Social Security on that investment portion. That's part of what we usually do when it comes to your estate planning, your exit strategy. You need to start taking a look at that. You could always contact the Social Security office. You can get a listing of your annual Social Security paid in, and then they'll also give you an estimate of what you would receive right now. And we'll usually work with people to that last 4 or 5 years before you finally close out the business and retire, try and get some benefit out of that, maximize that number, or if you're already maxed out, pull it back. There's no reason to throw money away.
Yeah, they don't want to throw money away.
Any other questions? All right, thank you very much.